to go back to its level, which was really the Bush tax rate, allowing it to go to that level, which is a couple percentage points higher, combined with making some modifications to the qualified business income deduction, which is now you're paying 80 cents on the dollar, taking that up to maybe 90 cents on the dollar. You do those two things together with a couple other tweaks here to 10% tax rate increase. That's what I think is the most likely scenario. And I think the question that you would have is when. That's probably either 2022 if they pass, tax law changes, or alternatively, the Trump tax changes expire in 2025. It could just happen naturally as that byproduct. So in terms of capital gains rates, there's been a lot of ballyhoo about, oh my gosh, what's going to happen with capital gains rates? They're going to be taxed, like crazy. There was so much back and forth on capital gains tax rates to get to the point where they're at, which is the 15% and 20%, respectively, depending on your income level, that I don't really see those changing a whole lot. What I do see them layering in is potentially a new tax on unrealized gains, unrealized portfolio gains above a certain level. And if you think about, well, why does that make sense? It's hard for me to argue against this point. If Gary's my dad, and
I'm not that old.
I know, but pretend that you are for a second. Work with me. Blaine couldn't make the call if Blaine was on. That'd be funny because Blaine actually is my dad's age. If you think about the unrealized gains tax, what that's really what they're really saying there is that right now the estate tax limitation is $22 million if you're married filing jointly. That's the gift from the government. So if Gary's my dad and he's at 20 million bucks, all liquid, all sitting in Apple and Microsoft stock. So it's all stock that he bought for $1 80 years ago. Gary dies. He's got this massive unrealized gain sitting in his portfolio, never been taxed. When he dies and I inherit it, I get a step up in basis to the valuation of the date of death, which is $20 million. And if I sell it, then I sell it effectively tax-free if I sell it one day later. So, that is part of the rules. We do estate tax planning around that all day long, and we're going to keep on doing it all day long while we can. And at the same time, man, it's hard to argue for that one. just philosophically, it's a great wealth transfer tactic, but I think the real intent of the estate tax limitation was to not tax me on Gary's hard-earned tax money, not Gary's hard-earned, untaxed, never taxed money. So that's what I think they really probably will do more likely on the capital gains tax perspective. So I promise my monologue is almost done here, Gary, but outside of that, from a tax planning perspective this year, I think knowing that there's a pending rate increase that could be coming, our job is pretty simple. It's to help you delay paying taxes until you're darn good and ready to pay them, which for most people is never, but at some point you might have to. And then the second is to change the nature of the tax itself from ordinary rates to capital gains rates or some lower effective rate. That's the two things that we're tasked with doing. Then the third is to get you fight for every deduction that you're legally entitled to, which in our world mostly means, how can we have as much owner fringe benefits as possible in our company without, going to jail. So we want to push the line, but we don't want to cross the line. Those are really the three things we focus on. So from that perspective, if you look at the third strategy, which is, deduct all that we can deduct, nothing really changed there. And there's not really much proposed rulemaking changes in a Biden administration on the owner fringe benefit standpoint. So that's probably pretty safe. Changing the character of the income to go, from ordinary to capital gains treatment because there's a rate difference, a real rate difference between the two. I don't see a whole lot changing there as well. So you kind of get into what's the value of the deferral and kicking the can because that was money that I could keep in my pocket, reinvest, and make money on. That's the real one that we're having to evaluate the strategy on, because our job is to evaluate your life as a taxpayer. And frankly, I'm going to have a hard time advising you to make that deferral or to continue with the deferral and in fact potentially make it even bigger if for some reason you're going to be paying a higher tax rate in the future, and that's certain. Usually when you're talking about like a 401k plan, stuff like that, it's like, well, you maybe have a higher tax rate in the future, but you don't know. I mean, right now we're saying it's likely in the next 2 to 4 years we will know. Thus, deferring taxes as a strategy for preferring cash, the window of opportunity for that being a super great idea is diminishing pretty rapidly. So we just want to think about it. That's kind of the biggest thing that we've been talking to within our client base as we go into tax planning. That, and also the deductibility of PPP funds. The IRS still hasn't changed their ridiculously incorrect position of being able to deduct the expenses associated with PPP funds right now. So, I got $100,000 from the government. I spent $100,000 on payroll. The $100,000 that I got isn't taxable, but I don't get deduct the $100,000 in payroll. That's taxable income. You just called it a different name. Stop being cute. Both sides of Congress agree that needs to be fixed. They just actually haven't fixed it yet. So our speculation is that it's going to get fixed probably either in the next stimulus round or sometime in kind of the March or April timeframe, which is when they'll usually do tax fixes that need to be made before people file their extension payments. It isn't something that all of a sudden the Democrats are going to raise their hand and say, that's a good idea. Actually, it's counterproductive to the Democratic position if we need more stimulus, not less, because that's effectively saying the stimulus itself was only worth 70% of what the stimulus was worth by making it taxable. So, we've been advising our clients that, unless you've got a compelling reason to go ahead and apply for forgiveness, you might as well just wait. So at least you're not paying in the 2020 tax year. You're deferring that payment until the 2021 tax year. And we think tax rates are safe in 2021, meaning that they're not going to change any. And the IRS is not taking any position that even if you have spent the money but don't have forgiveness authorized by the bank yet, that it's still taxable income. And in fact, that would be contrary to their position on all these questionnaires they're asking people to fill out for the greater than $2 million loans around, did you really need the money or not? Well, that's going to be pretty freaking material on whether or not we're treating this money as a loan or we're treating it as or we're treating it as money, stimulus money from you. So that's even further case for defer that application itself. Kind of the other big legislative thing that we just want to remind people to take advantage of is that, if you didn't get PPP funds, there are still employee tax credits that are available out there for continuing to pay people to work. One that, we really benefited. One of our clients was the FMLA, Family Medical Leave Act tax credit. So, a lot of us that have younger children, and in fact, if you play that credit out, it can be as big as the PPP loan itself over time. So the overlooked part of that is that if you went to a teleworking workforce because of school restrictions and things like that, that your workforce is hampered in working and you're paying them anyway. So that gap between kind of normal productivity and what you're actually getting, had they been coming to the office from 8 to 5 or whatever your normal working hours are, is kind of your window of being able to claim for the tax credit. And again, this client, it was hundreds of thousands of dollars, that they got. It wasn't quite, they would have gotten about two. It was a big company. They would have gotten 2.5 in PPP funds. But if you look at the tax credits themselves, it was a lot that they had available just by looking backwards back in the summer, and then you compound that forward, they're going to get about $1 million in tax credits versus their PPP loans, just for continuing to do what they were doing normally. That's one. The other one is the payroll tax credit deferral that exists. That's, you have the ability to defer the payment of employer portions of payroll taxes. I don't really see a reason not to do that. I mean, it's free government money. There's no interest on it. They haven't taken a position on whether or not those taxes are deductible or not if you haven't paid them and you're a cash basis taxpayer. We've seen that swing both ways in audits. So pending some rulemaking, chances are we'll probably try to make a case for deducting them, but just be aware that, it may be there's something that comes out that says you can't deduct those. Outside of that, the general things around depreciation still applies. With Section 179, you still have up to $1 million that you can place in service, and you still have 100% bonus depreciation for anything that you don't Section 179. So the way that we see that working, especially in light of the new tax law change, is, let's say that you're a capital intensive business. So you bought $1 million in equipment, and, for whatever reason, income's, down, you're at $500,000 in taxable income. Well, in a normal scenario, whether you Section 179 it or you bonused it, it didn't really matter because, you were taking income down to zero with Section 179 and you had a $500,000 carry forward. If you bonused it, you still got the $1 million deduction. You were taking the income to minus 500, but you couldn't do anything with it, thus it carried forward. Well, oh, nay. With the CARES Act, they brought back the carryback claim. So now you're actually better off driving that loss so that you can go back and get taxes from taxes from past years. It's an evaluation you'll have to make because with any carryback claim, you're really looking for the highest tax year. And it could be that the tax rates being higher in the future, you might want to think about preserving it for future years. But if you want to get your hands on the cash, you now have the possibility of doing a carryback claim. So the way to really maximize that is you Section 179, that same $1 million, you Section 179, 500 of it, and then you bonus the other part of it so that you can go backwards or just bonus the whole thing. You really want to look at maximizing Section 179 and bonus in order to drive a loss you can potentially take back if that's one of the attributes that you have available to you. So that's my opening monologue. I didn't get too many jokes in there, Gary, but those are the big things that we have been. I know that I did, of course, get my political bias in. I had to do that.
And the bad thing is we had to have this webinar set up by somebody else, and it was not on auto record as soon as we hit record. So the recording missed your political thing. So you may want to do a restatement at some point. But anyway, we got the meat of stuff in this. So it is recording. So anybody that came on late, and we had a fair amount of folks that were coming on, 10 minutes into this thing, we will put this up on the BGW CPA YouTube channel, probably tonight or tomorrow morning at this point. But you ready for some questions and some comments?
Sure, fire it up.
All right. So the first one is from Marty, and Marty is an optimist, I can tell by this question. And he's like, could we balance the budget like we did in early 1990s, early Gingrich style, where everybody takes a hit? You are an optimist, and I like your style, Marty.
Well, Marty, that you actually just made my point, which is, look, if you separate out the politics, entrepreneurs and business owners usually figure out a way to make money regardless of the administration. So we made money under a higher tax rate in that regime, and the budget was balanced. That kind of tells you that's about what the freaking tax rate needs to be to get to a balanced budget. unless we're going to make massive spending changes. So thank you, Marty. Vote Libertarian.
All right, next question is from Daryl. And Daryl, if you've been on our PPP webinars, which we do every Thursday at 11 a.m. Eastern time, we'll address this. This is a good question. So what if we've already filed for forgiveness of our PPP loan?
So it's a good question. It's technically going to be the date that you have the award made by the bank, which the bank is supposed to do within 60 days of your application. So, in theory, if you did that prior to October 31st, you could receive a determination. Otherwise, naturally, it could extend until the next year. I think if I was in that position, I would find out, well, look, did I really submit my application, or was that like your holding ground for when you're ready as the bank to submit the application? Because a lot of banks opened up the request process, but in the fine print said, by the way, we're not doing anything with this until there's more guidance out from the SBA, which is why there's been kind of a slow trickle of approvals that have occurred. So the first thing I find out is, look, am I really submitted or am I fake submitted? So let's say that you're real for realsies submitted, and it looks like it's going to be your 2020 year that you get the forgiveness get the forgiveness applied. At that point, you just really need to make a decision on what you think the outcome is going to be. And here's where it gets really tough. If you're a C corporation, you're technically supposed to be paying on income as you're earning it. So that's considered earned income. Technically, it should be part of your estimated tax payment and your extension payment. If you're not a C corporation, since it's kind of a bonus payment that occurred in the fourth quarter, if it puts you over last year, you would want to consider it in your extension payment on April 15th, 2020. If it puts you the same as last year, because if you add that to your income and you were down, then it should be part of your January 15th estimated payment. So the decision that you're going to have to make is, what's the risk of not paying? I mean, I can't, since we're recording the webinar and Gary distributes these to the Department of the Treasury, I can't in good conscience say, because it's a BS rule, don't pay the extension of the estimate. However, you would be subject to penalties and interest, which would be somewhat de minimis based on the timing. That's what you're evaluating, is the cost versus the consequence.
That was good. So for anybody that came on late, use the Q&A button. Now is the time to stump the chumps, and I'll be the chump. He's not. He's the crazy, in a good sort of way, professor. But nonetheless, now's a great opportunity to ask a really good expert on, hey, what should we be doing? And you can get very specific, and you can remain anonymous if you want. That's fine too. But we're here to serve you on this because Q4 is just about over. But by the time we hit Thanksgiving and Christmas, before you know it, we're going to be done. While we're waiting for that, one of the things that, and not knowing and looking at all the participants, not knowing who all's a client and who's not, one of the things that we have seen with non-clients that get frustrated with their CPAs and start knocking on our door, Adam, would you want to talk a little bit about some of the things that they could be talking with their CPAs if they're not with us about QBI, maybe R&D, stuff like that?
Yeah, I'll hit that, and then I'll also hit on charitable contributions here in a minute. So, probably I hit on this a little bit in the beginning of the call when I talked about how, if the tax rates change, they'll go up by 10%. Well, part of how they would get to that answer is that as part of the Tax Cuts and Jobs Act, it was purported to be a simplification, massive air quotes, of the tax code. It was the opposite of simplification. It was a complication. It was a business tax cut, period. That's all that it was. And I'm a big advocate for them doing it, because not just because, hey, I want to pay lower taxes. It's because we were on an unfair playing field when we've got, a really high corporate tax rate and other foreign jurisdictions have a really low tax rate. It's, that's why Apple's headquartered in Ireland. That's BS. I don't agree with that. That's not okay with me as a U.S. resident. That's not okay that they pay an effective 3% tax rate. I love Apple. I've got an Apple iPhone. I'm on an Apple iPad, and I'm mad as hell that they're paying 3%. It's a federal tax rate. It just doesn't seem, very fair. So by reducing the corporate tax rate from 35% down to 21%, it at least brought parity to the U.S. corporate tax rate, such that there wasn't as much of an incentive for companies to do the offshore shenanigans that they have been doing. So that was great. But the problem it created is that now C corporations have a tax advantage over partnerships and S corporations. So because they've got a lower rate. So the way they got around that is they said, well, we won't reduce the rate for S corporations and partnerships, but what we will do is only make you, if you're in a certain type of business, only make you pay 80 cents on the dollar, which is called the qualified business income deduction, subject to, look, you got to have payroll or you got to have a lot of property. Like, this can't just be a sham, type of business. Well, the thing that we saw within a lot of our clients, we had to make some pretty substantial adjustments on, and we still make adjustments on even to this day with our existing clients, is that, what should the CEO of a company be paid? That's always a question that we get asked, because you're supposed to get paid a reasonable wage, but there's no definition of reasonable wage. So prior to the Tax Cuts and Jobs Act, if I paid myself $500,000 in wage, or I paid myself $500,000 in just let the company make the money and I took out a distribution, not a huge tax rate difference. Sure, there was some de minimis Social Security, Medicare surtax on the wage piece that was real money, but it was like a couple grand versus the distribution. So not a lot of people made big changes for that. However, if I'm only paying 80 cents on the dollar, that same $500,000 is now all of a sudden 400 grand in taxable income. So I saved 100 grand that wasn't even taxed at 40%. That's 40 grand. Now we're talking real dollars that people all of a sudden ears are perking up saying, hey, we ought to really look at this. So it does require that you really look at what should my wages be versus what should my distributions be, if you haven't looked at that in a while. And, the only data that we have to go by as to what that reasonable wage should be is tax court, which is, if you make 100 grand, then 25% of it should at least be wage, 75% of it can be distributions. And that's the aggressive end of the spectrum. So what happens though when you get larger than that? I mean, we've had owners that have kept that formula in place forever. And now they've got $1 million W-2s because they've got really successful businesses. Well, that's ridiculous. If you really think about it, that same person, if they were to go to, shout out to one of our clients, Cameron Carmichael, you go to them to try to hire a CEO of your company, your rate is going to probably be about 250 grand, and you're going to have to give them some equity. So guess what? That's the market rate for a middle market CEO. That's one data point. Another data point is, what's the Social Security limit? Because that's what all this is all about, and what they really care about in the first place is that I'm not avoiding Social Security taxes. Well, that's 140 grand. So, there's no reason that you can't be in that strike zone, and everything else I feel like is at play for an adjustment and an evaluation. That's not, that also applies to spouse. You know, if you've got spouses on payroll too, it's like you got to look at yourselves as a collective unit and evaluate what you've been putting in a 401k on behalf of your spouse relative to, well, I just gave up the deduction that I could have had at a historically low tax rate with the qualified business income deduction. That's one thing that we find a lot. On the R&D tax credit, the research and development tax credit, that's another one where, you know, a lot of people get hung up on, do I qualify for that or not? That's basically dollar for dollar. It's tax credit, so it's dollar for dollar on labor that you spend for qualifying research purposes. A lot of people are like, I don't even qualify research. What the heck is that? Look, what I'll tell you about qualified research is the only thing in the tax code that they say isn't qualified tax research is this webinar, because they specifically say tax shelters are not considered qualified research, meaning like the creation of intellectual property associated with creation of tax shelters is not is not research and development. You know, same thing for attorneys, like the writing of a will, you know, probably not going to be intellectual property. Outside of that, it's actually pretty liberal in terms of what could qualify. You know, if you manufacture something, you know, technology, you know, process oriented, you know, basically anything that you feel like, look, if a competitor could do that and they knew what my little secret sauce was, that'd be bad for business. Even if anybody could figure this out, I'm the one that figured it out first and I charge a premium for it. You might have a case to take the R&D credit, and it's really worth looking at. You know, that's another one where, you know, within our client base, we've gotten, you know, hundreds of thousands of dollars back for our clients for doing that. On tax credits, I'd also be remiss, you know, restaurant and hospitality industry, you know, a lot of you guys, blah, 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 I never heard this, I never heard this. When you guys were shut down, you know, you started paying, you kept on paying people under the table to try to make them whole. You know, kind of the downside of that not being through payroll is that it's technically shouldn't be a deduction unless it's income to the recipient. But even if I forgo that, you know, you're missing out on the FICA tip credit, which is for, you know, restaurants, food service businesses specifically, by going that route. So that's a case where you might want to rethink what you did in the middle of pandemic to try to make people whole by not maybe considering reversing direction and making sure that goes through payroll, you know, as it really should have been in the first place, so you can maximize FICA tip credit. It's not really going to likely cost the employee that much to do it, especially if they're working for you now. So just a consideration to have.
So a couple comments. Marty, thank you for jumping on some of these questions and thoughts. And I'll start with a comment first where he said he's known Spike Cohen, which was the independent VP candidate since he was a teenager. And I think Spike Cohen is in Myrtle Beach. So I would assume that you're probably in Myrtle Beach area. So, and here's here's another thought, I guess, and maybe you can opine on this, Adam, but he said, I paid my first and second estimates based on last year, which was a great year. And Carl had said, since this year will be very low, not to pay my estimates, I may owe less than what I've already paid. Thoughts?
Yeah, that's correct. So basically, you know, with estimated payments, I mean, you're basically paying off the prior year or you're paying off the current year, and you're ideally picking the lesser of. So with the prior year, it's either 100% or 110% of the prior year obligation, depending on what your income level was. Well, with the current year, it can be 90%. And what's great about that, when I say great, what's also great about that is that you can also look at annualizing that, meaning if there was seasonality associated with your business, you can say, well, look, I really didn't make crap in the first quarter, and you know, I really made most of my money in the fourth quarter, which allows you to push out and defer the timing of the payment. So, yay, Carl. Definitely good advice. The only consideration that you're going to want to have is that if you did already do the PPP forgiveness, you know, you technically should, and you got it granted, you technically should be considering that income. So that's going to go back to your stomach for not paying because something's BS, and just accepting that there could be penalty and interest associated with that you'd have to deal with, and you're technically breaking. I'm gonna go to hell for that, Gary, but you're technically breaking the law.
And just a reminder, we do not advocate skirting the line, pushing the line, or breaking the ethical or legal limits, just so you know. That is a true statement.
Yeah, I just philosophically have a real problem with stupid taxes.
The way I say it with when I'm talking with somebody that's talking about coming over as a new client for us is having had good CPAs and not so good CPAs in some of the companies that I've run. There are a lot of CPAs are very, very super conservative where they're just checking the boxes. And having been in the securities world, it's the equivalent of having a 32-year-old that just had a massive liquidity event on the company that he sold or she, and let's say they made 20 million bucks or whatever, and having a financial advisor say, well, you need to put all your money in CDs. Well, that is actually securities malfeasance because it's not suitable. It's not suitable for that particular risk tolerance or age of that investor. And I think the way that we look at it is, hey, there's a spectrum from the most conservative where I feel guilty for being a capitalist, and so I'm going to pay extra just because I feel guilty about being a capitalist, to the ethical and legal line. And there is a spectrum of possibilities within there. You just need to know the risks and rewards. You're adults as business owners. And I think our job is to educate you on what the risks and rewards in that spectrum is. So,
yeah. So that's a great segue to charitable contributions. So, if you feel guilty for being a capitalist, my vote would be charity, not the freaking government, because government's not a damn charity. So you still ought to be deducting everything possible. So with that in mind, another thing that I think we saw as part of the Tax Cuts and Jobs Act that could be relevant for this year for some people when it comes to charitable contributions from within a business is that, remember what happens is that, if I had $100,000 in taxable income, on my, P&L, but embedded within that is a $10,000 charitable contribution. So on my books and records, I took it as an expense, right? Well, from a deductibility standpoint, what technically ends up happening is it's still deductible. It's just in a different way. So that 10 grand gets added back into your business income. So now you made 110 grand and gets put on your K1 that then goes on your personal return as a charitable contribution. So in theory, in any other world that we live in, you're even Steven. Add it back to income, got an itemized deduction. Well, where the Tax Cuts and Jobs Act really changed that, and I bring it up because we did have to fix some things last year, and if people were charitably inclined this year, we're really just going to want to think about it, is that if you didn't have a mortgage, you otherwise were kind of, middle of the road guy, married filing jointly, well, your free gift from the government was, thanks, Joe, that's pretty funny. Yeah, no, it can't be Pappy Van Winkle for your CPA. I am taking deliveries. What ends up happening is you've got, 20 grand of freebies from just your itemized deductions. Like your standard deduction is 20 grand married filing jointly. So that means I don't even need that 10 grand of the charitable contribution because I can't take it anyway because I already had a 20 grand freebie. It's not 20 grand plus my 10 grand. It's the greater of 20 grand or the sum of all my itemized deductions. And if that charitable contribution was my only itemized deduction, I got nothing. So I'd be way better off. Again, we're not publishing this for the Department of Treasury, but really looking at the charitable contribution to say, look, was it a freaking marketing expense? Seriously, like, the golf tournament that I took the clients to, what like was like, shouldn't I at least contemplate deducting the fair price of the golf round as a marketing expense, and any excess is a charitable contribution, so I can at least maximize the deduction for my own use. So just something to think about when it comes to charitable contributions. The other one, actually, this is the not funny version of Joe's comment about qualified thing, is that, for a lot of our clients, we did conservation easements, which, basically a lot of people have heard of them, but only like they heard that they're a thing. What a conservation easement is, let's say that if you take like Romeo Bearden Park here in Charlotte, right? So that's a beautiful park sitting in the middle of freaking downtown Charlotte. Well, if I was the guy that owned that property and I was ready to develop it into the View, the View is going to be, call it a $50 million property when it's all said and done. And I bought Romeo Bearden Park property for $100,000, years ago, just been sitting on it. Well, I go to build the View and they find the endangered water slug on the property. Thus, I may not build because the environmentalists are really mad about that water slug, and it must live in its natural habitat at Romeo Bearden Park. It would be devastating to move the water slug out of that. So if that's my set of facts, I'm screwed. I got a valuable piece of property that I can't develop. I can't do anything with. So what I can do with that is I can grant a permanent easement. So I'm not really selling it. I can grant a permanent easement to the city of Charlotte to do what they want with it. And what I get is the $50 million charitable deduction of the value that I forewent for giving it up. Well, that was a great concept where people started getting into trouble. I'm going to get political again, so forewarning, Gary. Where people got into trouble with that and the IRS started raising it as a red flag is, first off, America. First off, if you had a crazy valuation, on the property itself, it's like, look, it's freaking uninhabitable, mosquito infested swampland in Alabama that nobody and their brother would ever build on in a bajillion freaking years. And you're trying to tell me that you're going to build the Taj Mahal on it? Forget about it. No, we're not buying that. That was problem number one. And they've always been cracking down on those. Well, problem number two, to get political, is the
America
Trump. Well, it's the Trump retreat, frankly. I mean, I can't remember where the property at. I think it's on the Hamptons, and it's, part of what the guy got audited for, per the New York Times article, is that, he bought a great property, then granted a conservation easement to it saying, hey, so-and-so has a right to use this property. And then all over freaking social media, they're calling it the Trump family retreat. Part of the deal is you don't get to use the property anymore. So like, you can't grant a conservation easement and then build houses on the freaking property. Like, that's no. So they started coming after people for that. Then the last category is, the one that would have most commonly impacted our clients, which is, look, these are fine concepts and we're all for them because they serve that, like Catawba Land Conservancy wouldn't exist today if it weren't for conservation easements. So they serve a valuable societal purpose. However, Gary can't buy it for the purpose of getting a tax deduction. Gary, you want this? You go buy the damn land and donate it yourself. So they started cracking down on syndicated conservation easements, which is the most common thing that we have with our clients, which is, you're buying into a partnership that bought the land, granted the easement, and then you got a K1 with the charitable contribution, but you never directly own the land. Everything else was all above board, you know, in terms of valuation purpose, all that kind of stuff. Well, they're trying to take a position that those don't qualify. They haven't won anything to my knowledge on it, but you know, it kind of has slowed down the appetite in the market for that as a deduction. But you know, if you're willing to take the risk, it's still out there. You know, there still are products that you can get into on the easement side. And you know, if you think about how it works, it's like I pay $100, I get a $400 charitable contribution that reduces my income if I'm within the realm of the valuation ratios. That $400 reduces my tax by $160. So 100 got me 160. I should do that all day long, up to limitations, but you just have to recognize that there's risk involved with that.
So this is not a question that somebody posed here, but I have heard it, and that is, you know, provided, you know, the election stands and there aren't electronic hanging chads that make a difference, who knows?
Or Dominion voting machines.
It could be. Stay tuned. But
whatever, Gary.
Could be. I'm still standing by that one. So
wait a second. Here's Gary. That was my head buried in the sand.
We'll see. So here's my question. What I have had posed to me is, what about qualified or the opportunity zones that were set up, and you know, speculation that if Biden comes through, those things has been. Have you heard anything, or have you thought about that?
I think that that's just speculation, because, you know, investment in, I mean, if you think about, well, what was that really? It was an investment in distressed areas to help those areas recover and rebound. Now, could I make the argument that we got just a wee bit on the liberal side with where we located those? But man, those kinds of things have been around through both Republican and Democratic administrations in some format for a while. So I don't see those going away. I think, especially with the push on racial equality, you know, I really feel, because that's really what it's trying to get at. I don't see that going away. Like, I still see that being a vehicle. Now, for sure, I don't see him coming back and making something retroactive. They've never had a history of doing that. But in terms of them being opportunities for investment going forward, there's a chance, I think, potentially. And at the same time, in that window of time, you just have to evaluate. There's only so many zones available. So, you know, it could be that there's just not a lot of stuff in them anyway. From a real estate perspective, you know, you can also still like locating your business also counts. And in fact, what I would hope the administration would do is fix what I think is an incredible injustice in the whole deal, which is you can only use freaking capital gains proceeds to invest in the first place to qualify for the, like, why is it that I can take $1 that I earn through my wage and invest in an opportunity zone and I don't get boo, versus I took $1 that I earned on Apple stock and invest it and I get everything in the world? It just doesn't make any sense to me. So I would in fact hope that, based on the push for racial justice and the underlying premise of racial justice is all around getting your way out of poverty, and the whole way of getting your way out of poverty is, you know, giving people in disadvantaged economic areas a leg up and a chance by making investments in them. I'm optimistically holding that that's going to get even better.
Awesome.
As Joe would say, if I was president for a day, I would do that.
There are times I wish you were president for a day, and maybe even more. We could use some more common sense at all.
There's too many people with evidence and pictures.
Yeah, there you go. Well, yeah. Yeah, I hear you. We did get another comment. So Marty, thank you for saying that. Great webinar. Thank you. Let's do more of these if you can. So appreciate that. Here's a good question. To qualify for Section 179, which assets qualify for 2020? Great question.
Yeah, so I mean, the first question is, it's got to be placed in service within the calendar year. That thing always applies. And then the other thing is it's got to be new to you. So that's the other piece for it to qualify.
So you still have some time. You got 6 weeks before the end of the year. So hopefully that answers the question. Any other questions from the gallery out there? And again, for anybody that came on late, we will post this thing up on the BGW CPA YouTube channel. May not be tonight, maybe it will, I don't know. Depends on how long it takes to download this from the cloud and then get it up, but it'll be up tomorrow for sure. Next question, probably as a follow on Section 179, are there dollar limitations? $1 million.
Yeah, we hit that at the beginning. I mean, it's still subject to the $1 million cap, and you got to look at that. You got to remember that that's also on an aggregated basis. So I can't, do $1 million here in one company, $1 million there, and that'd be a good problem to have because you got a big company. But, it's subject to both an aggregated cap of equipment placed in service, and then also the same income thing on the cap. That's why I don't know if it's recorded or not, but at the beginning of the call, especially because you can now take a loss backwards. If you place enough capital equipment in service that either through Section 179 or through bonus depreciation, you could have driven a loss, you really need to dig in and pick which assets you want to do what with to potentially help drive a loss that would be a carryback, because with 179, you're not actually creating a loss, you're just stopping at zero. And then you've got some money to carry forward, whereas with bonus depreciation, you're actually creating a loss.
Any other questions out there? These have been good ones. And thanks for the encouragement, Marty. We always like that too. So any other thoughts while we're waiting? If there are no other questions, that's fine. We'll wind this sucker down. But, Adam, if somebody is not a BGW client, what are the additional things that you would have them, or if you maybe just do a recap of things that they ought to be asking their CPA and their tax professional for advice on these things?
Yeah, I mean, probably obviously when it comes to PPP, what am I doing with my loan application would be one, and, kind of picking the year that you potentially want to make that application. But, the second component is, really all around, look, I want to know what I owe this year. And I definitely want to know that I'm maximizing everything that I should maximize in terms of qualified business income deduction, owner fringe benefits, and all that. But if you've got a big timing deferral that's in existence, meaning like, man, I've been prepaying that same rent for years, or, every year I've added 10 grand to it, whatever the number is. And we've got clients that, through very legal reasons or very legal mechanisms, have millions of dollars in untaxed deferral money. I think getting your arms around how big is that number? And since I just got some free government money through PPP, do I want to consider taking some of that money off the table and letting it get taxed at what will likely be the lowest rate that we're going to see in a long time? And, I've joked with a lot of our clients, it's like, look, you're going to call me a lazy freaking CPA for telling you what's your tax plan this year? Nothing. In fact, I think you ought to pay more. I mean, it's like, I hate saying that, But the reason that I'm saying that is because it would cause me to be physically ill to have you pay more in the future. And we've got what I would point you to, whether you're a client or not. It's on the BGW YouTube channel. I did an explainer video on this very concept to show you, effectively what you need to evaluate is, look, if I had $1 today that was untaxed, what's the rate of return that I would need to make on that, such that what it made in a higher rate environment is still more money net to me than had I just had it taxed and still made money, but then had basis in it. And, depending on the rate of return and the tax rates, it's pretty high rate. I mean, it could be 20% or more that you need to be making with kind of a 3-year investment horizon window before you're in the money on that deferral. So I think just, knowing the size of the deferral and deciding whether or not this is the year you start taking it off the table, I think it's pretty important, because our job is to manage your income, over your life. I think that's one. The second one that I didn't talk about in the earlier part of the conversation, but it bears repeating, is that nobody likes talking about their death at all. When I go out and meet with our clients, and I say, well, hey, let's talk about death. I mean, nobody jumps up and down and says, oh, can we? Can we talk about me dying? But, part of the tax law change that happened was the estate tax limitation went from effectively $11 million if you're married filing jointly to $22 million. So double. That's great. It's a nice problem to have. But that goes away. And we don't know what's going to happen after that, other than it reverts back to the $11 million. So if I've got, if I knew that I had a taxable estate, period, at the $11 million level, all that gifting that I've been procrastinating because I didn't want to think about my own death, I would really want to start thinking about it and doing something about it, because I've still got this $22 million window. Now, they've not said what happens if you were over the money and they revert back, what happened in that window of time. But the only case that we have is when there was no estate tax. That was the year that George Steinbrenner held his breath to die, in the year that there was no estate tax. If you're a Yankees fan, that was an inside joke. And they didn't tax the Steinbrenner family by saying, oh, now we have an estate tax again, let's go retroactively. So the likelihood is it probably won't go retroactive. And you would just be a fool to not do something about that one-time increase that you got available at your disposal. That if you go back to kind of the earlier theory that tax rates are probably going to go up, I don't know, man. I don't see a whole lot of senators and congressmen saying, but we must protect $22 million estates. I mean, I got a hard time believing that anybody's going to be, when you got to give some points up, I don't see anybody saying, well, that's the thing that I'm going to stake my reputation, my career on, is a freaking estate tax. So definitely be looking at that. And the reason I say look at it is that with estate tax law, time is your ally, because you still have, even though there was some IRS proposed rulemaking on the ability to take discounts, meaning like, privately held companies, it's hard to determine the value. So I could have something that I could sell tomorrow for $100 million that for the purpose of an estate tax, I might value at $20 million because I just don't know. So there's all sorts of discounting that you can do in that process. Well, time being your ally, the key to time being your ally is that when you do a gift for the purposes of reducing your taxable estate, it establishes a clock. And part of establishing that clock is that you disclose the method of the valuation and the discount that you took, which means you're basically saying to the IRS, yeah, I took a discount, bring it on, tampon. That starts your stack. That was my brother-in-law's old saying, so sorry if I offended anybody with that. That starts your statute of limitations with the IRS. Now you got a 3-year window whereby they can challenge the value of that gift. And that's only going to happen if for some reason they start auditing gifts, which I haven't seen done in my career. I'm sure that there's somebody that has, but I've not seen an estate where the person was still alive audit on the gift, or you die in that 3-year window. Outside of that, it's done. No going backwards. You did it. So if it was me, I would say, look, if this stuff expires, I want my gifting to have occurred 3 years prior, which is next freaking year, people. So that's why I would really be looking hard at the gifting piece. And frankly, for the business owners that are out there on the call, I'm sorry, and I know we're running over on time, Gary, but I'm going to continue with my tirade. Get over yourselves. Gifting is a highly emotional decision. There are ways to do it, in which case you're still going to have an income and maintain control. The perfectly logical answer is to die with nothing and pay no estate tax and have exactly the amount of money that you need to support you until you die, which will be on a specific date. That's the perfectly logical answer. Anything else is just pure emotion. So just, one to think about.
Yeah, we've got great referral partners that can go deep and wide in that. And I know just locally, the guy that runs National Christian Foundation, John Putnam, is a good friend, and they have done some amazing things that have been able to help companies. Movement Mortgages is one of those that they've done some amazing things in Charlotte and made huge impact. And, they've got viable companies. It's really interesting to see some of the stuff going on there. So here's a scenario. Does this make sense? I personally give a settlement check I received as a loan to my LLC S Corp, then use the cash to purchase Section 179 assets as a way to reduce my tax liability on Schedule K.
So I'm going to use real numbers. So I got $100,000 settlement check. Then I loaned that $100,000 to my S corporation, and I bought $100,000 in assets. All else being equal, you're hoping that $100,000 of assets that you bought wipes out the $100,000 settlement check on the assumption that it was taxable income. Yeah, that totally works. If the settlement itself was not considered taxable income, so I really would look at that. It's like, what was the nature of the damage? Was it to make you whole, or was it punitive in nature? So you'd have to look at what was the actual settlement to determine whether or not it was taxable or not. Because if it was to make you whole, it's generally not taxable. If it was punitive, then it typically is. I think I got that right. Blaine's not on here to fact check me. So I just would make sure that it's actually taxable first before doing anything with it. But on the assumption it is, and you're trying to wipe the two out, you're good to go.
So it was a workers' comp settlement.
Yeah, I mean, that's wage. So
there you go. Hopefully that helps. Good question. We've had some great questions on this one today. We usually do, even on our PPP, we get some really good questions. And sometimes we get the same questions over and over, but it's been a complicated and ever-changing target out there on PPP in particular. Well, hopefully this has been valuable to people. It seems like, based on the quality of questions, it has been. Again, just want to say thank you, guys. If you have another question that you want to squeak in here, do it now. Otherwise, we're going to wind this thing down. But thank you for taking time out of your day to join us. If you have any other things that kind of come up afterwards, feel free to join us on our PPP webinars, because we are also talking about other implications for business owners. So especially now that we're in Q4 planning season. So thank you again for your time. Adam, it's always fun to hear you do your magic. So thank you for that.
I do appreciate that. And I guess one thing I would say that was Gary's job, but I'll say it, is that we did just release a new website. So shout out to Nomad, the company that helped us do that. And part of what we're going to be doing with that is creating a special access component called the Vault, which is going to be open to our clients. And then you can also get a subscription to it to try it out for free, and then ultimately pay for it if you're not a client at BGW. And it's going to have a lot more detailed explainer content like this. Like, I heard you say own a fringe benefit. I don't even know what those are. So what are the things that I'd have the ability to deduct? So or I heard you talk about estate. I don't even know what the heck are you talking about, Willis, with estate tax. So we're going live with that in January. So what I would encourage you guys to do is, check out the website, www.trustbgw.com. I'm sure Gary's going to be nice enough to throw it in the chat link. And there's a registration for the Vault just to be set up for it as you get started, because the first content that we are going to focus on is getting into the weeds of what you need to know as a business owner to minimize and manage your tax liability. Because, we're really good at a lot of stuff, but, that's really, we view that as like our most sacred duty is to help you keep as much money in your pocket as you possibly can on the IRS side. And then everything else is an add-on to that. So.
Yeah, good job. I appreciate you serving as my safety net on that. I do appreciate it.
Well, I did stay at a Holiday Inn last night, so I got you covered.
Yeah, it's good. And if we're shooting for January, but we've got Adam kind of buried alive with Q4 planning, and he's going to be driving a lot of that content. So
no, I'm going to get it done.
All right. I'm
Challenge accepted. I threw it out there in public.
I'm saying Q1, but you've got it on tape here now, so it's January. But yeah, there's a lot of good stuff already on there, even with some of the videos. But you can also go onto the BGW YouTube channel, and there are various channels that you can go deeper into. So whether it be PPP, all of our webinars that we've done there, or some of these explainer videos, tax planning, et cetera. Some of those things are there now as well. And that's free for the public. So again, thank you, everybody. Adam, any final parting words of wisdom?
I hope the Democrats and Republicans start acting like more libertarians, because it's not like a libertarian's ever going to win a race.
Yeah, that's true. I think you're right.
So.
All right. Well, thank you. Everybody have a wonderful day. Join us tomorrow morning at 11 o'clock Eastern time for PPP Fun and Frivolity. And we also bring into the mix Jack Senton Yellow from Shoemaker Law. And it's always fun having him. So thank you again. Have a great evening, y'all. Bye-bye.
All right. Thanks, Gary.